Are you looking for the best way to tap into fast-growing companies without the stress of picking individual stocks? Well, in this video, I reveal the 5 best growth ETF you should be adding to your portfolio now. These ETF give you exposure to fast-growing companies while reducing the risk of any one stock dragging down your returns. Many investors pulled back from growth stocks in 2022 because of rising interest rates and recession fears. But the market has since rebounded strongly. As we look ahead, ease in inflation and potential interest rate cuts from the Federal Reserve could boost growth stocks, especially in the technology and communication services sector. This momentum is likely to continue, providing further upside for growth investors. Make sure you are subscribed to Financially Well and hit the notification bell so you can stay ahead with our latest investment tips. Here are the 5 best growth ETFs for explosive returns. Invesco QQQ ETF with ticker symbol QQQ. This ETF manages $289.5 billion in assets with a dividend yield of 0.6% and an expense ratio of 0.2%. That's $20 a year for every $10,000 you invest. Now, what makes this ETF special is that it focuses on 100 of the most innovative companies listed on the NASDAQ. It's heavily weighted towards tech, which makes up 51% of its holdings. You've also got 16% in communication services and 12% in consumer discretionary stocks. And yes, Apple and Nvidia alone make up over 17% of the portfolio. QQQ tracks the NASDAQ 100 index, meaning it's packed with top non-financial companies. It's also super liquid, making it a favorite for traders. But if you are more of a long-term buy and hold investor, you might want to check out its sibling, the Invesco NASDAQ 100 Index Fund, ticker symbol QQQM. QQQM has a lower expense ratio at 0.15%, but QQQ wins when it comes to trading volume. Now, over the past decade, QQQ has averaged an impressive 18% annualized return, beating out the SPDR S&P 500 ETF, SPY, which came in at 13%. Vanguard Growth ETF, VUG. This ETF is huge, managing $136.8 billion in assets with a dividend yield of 0.5%. The best part? It's super low cost, charging only 0.04% annually, making it one of the most affordable ways to invest in large-cap growth stocks out there. VUG tracks the CRSP US Large Cap Growth Index, which focuses on 200 large-cap growth companies using factors like earnings and sales growth over the last 3 years. The median market cap of companies in VUG is $1.2 trillion. So you're looking at some serious mega cap stocks. Nearly 60% of the portfolio is in stocks, with consumer discretionary stocks making up 17%. The top 10 holdings, led by Apple, Microsoft, and Nvidia, make up 60% of the total assets. Now here is the exciting part. These companies are growing fast, averaging a 22% earnings increase over the last 5 years. Of course, they come at a premium, trading at 37 times earnings and nearly 11 times book value. With a low annual turnover of just 5%, VUG has delivered a solid 17.9% annualized return over the past decade, making it a strong contender for my growth-focused investors. The third ETF, iShares S&P 500 Growth ETF, IVW. This ETF tracks the S&P 500 Growth Index, which selects growth-oriented stocks from the S&P 500 based on factors like earnings growth, sales growth, and price performance. It has about 230 holdings with a median market cap of $664 billion. So most of the stocks are large or mega cap with only a small percentage in mid caps. In terms of sector weightings, technology dominates with 50%, followed by communication services at 13% and consumer discretionary at 11%. The top 10 holdings, including giants like Apple and Microsoft, make up 59% of its $53 billion in assets. Launched back in mid-2000, IVW has averaged an annual return of 7.8%, turning a $10,000 investment 23 years ago into nearly $43,000 today. With a management fee of just 0.18%, it's a solid option for those of you looking to invest in growth stocks. If you're a dividend investor looking to expand beyond U.S. markets, the Wisdom Tree International Hedge Quality Dividend Growth Fund, ticker symbol IHDG, is worth considering. This ETF focuses on international stocks outside the US and Canada and is designed to minimize currency fluctuations between the US dollar and foreign currencies. IHDG tracks the Wisdom Tree International Hedge Quality Dividend Growth Index, which selects 300 companies based on growth and quality. Companies are weighted based on the dividend they pay, so those paying higher dividend get a larger share of the portfolio. Its top 3 countries by weight are the United Kingdom at 18%, Japan at 15%, and Switzerland also at 15%. There is also a small US exposure, but none in mainland China. IHDG has a solid dividend yield of 1.6%, higher than the S&P 500's 1.3%. Since its launch in 2014, a $10,000 investment in IHDG would be worth $26,000 today. That's an impressive annual return of nearly 12% over the past 5 years, despite some weaker performance from European stocks. A key factor in this success is the ETF's strong dividend and hedging strategy. The ETF holds around 250 stocks, with the largest position, Spanish retailer Industria de Diseño Textil, accounting for over 5% of the fund's $2.8 billion in assets. The top 10 holdings make up about 35% of the portfolio, and the top sectors are healthcare, 21%, consumer discretionary at 20%, and industrials at 18%. When you're building a diversified portfolio of the best growth ETFs, adding a small cap fund is a smart move. One solid option is the SPDR S&P 600 Small Cap Growth ETF, ticker symbol SLYG. Launched in September of 2000, SLYG has grown to $3.5 billion in assets. While it's smaller than the well-known iShares Russell 2000 ETF, IWM, SLYG tracks the S&P Small Cap 600 Growth Index, focusing on small cap stocks with strong growth characteristics like sales growth and earning momentum. The fund's holdings have an average market cap of $3.8 billion, with earnings per share growth of 13.7% over 3 to 5 years and a price-to-earning ratio of 17.3%. Sector-wide, it's led by industrials at 18%, consumer discretionary at 16%, and technology at 15%. Its top 10 holdings make up only 12% of the portfolio, meaning no single stock has too much influence. Key holdings include Fabrinet and the Ensign Group. One of the perks of SLYG is its low expense ratio of a mere 0.15%, thanks to its once-a-year rebalancing, which happens in December. Since its inception, SLYG has delivered an annual total return of 7.1%, making it a solid small-cap growth stock option. If you like this video, you'll also like this one on the absolute best dividend ETFs. Be sure to like, share, and subscribe to Financially Well. Let me know your thoughts in the comments below. And as always, stay financially savvy. See you in the next video.